Imagine opening a letter from your insurance company. It doesn't raise your rates, it ends your policy. Now picture 1.9 million of those letters, blanketing states from California's wildfire canyons to Louisiana's hurricane bayous. This isn't hypothetical. It's a slow-motion collapse of the American dream. In this video, we'll uncover why insurers are fleeing entire states, trace the fault lines from Paradise to New Orleans, and reveal the domino effect. From the canary that stopped singing to a new map of America. So what happens when your home becomes uninsurable? Forget the image of a sick canary, tweet weak and wobbly in its cage. In this story, the canary isn't just ill. It has simply dropped dead. The coal mine in this metaphor? That's the entire American home insurance market. And the poisonous gas? That's climate risk. The warning signal isn't a fading chirp, but a deafening, corporate silence. A 2024 congressional report delivered the grim autopsy. Nationwide, 1.9 million home insurance contracts have not been renewed since 2018. This isn't a market adjustment. It's a map of retreat. Nowhere is this collapse sharper than in California. The canary fell silent there during the firestorms of 2017 and 2018. Those two back-to-back wildfire seasons devoured decades of actuarial wisdom. Insurers paid out a staggering $29 billion in claims, a sum greater than the previous 4 decades combined. The math they trusted simply broke. The result was a corporate roll call of retreat. State Farm announced it was cutting 72,000 policies. Nationwide private client stopped renewing everyone. And giants like Tokio Marine and Trans-Pacific just pulled the plug entirely, filing to leave the state for good. This is not one company's bad quarter. It's a market consensus that the risk is no longer calculable. The old equation is dead. So, what happens when the math breaks? See, here's the thing about insurance. It's built on a simple, almost beautiful idea: pooling risk. I pay a little, you pay a little, and if one of our houses burns down, the pot covers it. That math only works if the fires don't come for all of us at once. That's exactly what happened in Louisiana. After a brutal string of hurricanes, Laura, Delta, Zeta, Ida, Ian, the pot was empty. A dozen insurers went bankrupt. Just 2 of those storms, Ida and Ian, racked up $43 billion in claims. And here's where the ghost appears: reinsurance. The safety net for insurers. Global giants like Swiss Re and Munich Re, spooked by cascading climate losses, hiked prices or pulled back entirely. That left smaller companies like Falls Lake with no backup. No choice but to flee. So now, insurers are ditching historical records for forward-looking catastrophe models. These aren't your grandpa's actuarial tables. They simulate storm tracks, wildfire paths, rising seas, and they paint a grim picture, declaring vast swaths of the country uninsurable. The math of old no longer adds up, and the new math says, run. That math we just broke down, it doesn't live on a spreadsheet. It lands on kitchen tables. Between 2020 and 2023, the average homeowner's insurance premium nationwide spiked by a crushing 33%. In Colorado, the average annual cost hit a staggering $4,599. This isn't a mundane bill anymore. It's a household crisis. And when private insurers flee, there's only one place left to turn: the insurer of last resort. State-run FAIR plans. These are the expensive, threadbare safety nets that are now the only option for millions of people. And they are bursting at the seams. But the pain isn't distributed equally. The U.S. Treasury Department dropped a bombshell in 2024. Non-renewal rates are 80% higher in the highest risk areas. Think about that. A wealthy coastal enclave gets to keep its coverage, while a working-class inland community, battered by the same storms, gets dropped. It's a tale of 2 zip codes, and it forces an impossible choice. Imagine a family facing a renewal notice where the premium now exceeds their monthly mortgage payment. The math grinds to a halt. Do you face financial ruin trying to hold on, or do you walk away from your home, your schools, your entire community? That's not an insurance problem. That's a human catastrophe. But this crisis didn't just happen spontaneously. Someone set the rules of the game, and that brings us to the regulator's dilemma. Now we arrive at the regulator's dilemma. In 1988, California voters passed Proposition 103, a law designed to protect consumers from price gouging by capping insurance rate hikes. It was a shield. But now, that shield is becoming a trap. Because insurers say they can't raise rates enough to cover the exploding cost of wildfires, they're just leaving. So in 2025, Insurance Commissioner Ricardo Lara made a bold move. He mandated that insurers must write policies in high-risk areas if they want those rate increases. His words: "For 30 years, insurance companies have raised rates without any obligation to remain in the market. That ends now." But the industry pushes back hard. Blades, an industry analyst, warns that with catastrophe costs at historic highs and reconstruction costs skyrocketing, they simply can't afford to offer coverage in high-risk areas. It's a standoff. The government says you can't just take the money and run, and insurers say you can't force us to lose money. And this isn't just California. Look at Colorado. In 2022, 76% of insurers pulled back from high-risk areas, leaving just 5 companies to control the entire market. That's not competition. That's an oligopoly formed by climate fear. When the market fails, who steps in? That's the question dragging us into the next chapter, a new map of America. Now zoom out with me. Look at this map of the United States. Not the one from your grade school classroom. Strip away the state lines. What you see instead are zones. Deep indigo for floodwaters swallowing Louisiana and Florida. Burnt sienna for wildfire smoke smothering California and Colorado. Last year in Colorado, 76% of insurers pulled back from high-risk areas. These are insurability maps, and huge patches are shaded as no-go zones. In 2023, the U.S. had 28 separate billion-dollar disasters. Then in January 2025, the Southern California wildfires tore through, adding a preliminary $40 billion in losses. That's not some distant scenario. It's happening now. Now, connect that to the house you're living in. Think about your 30-year mortgage. The bank required you to have insurance. But what if that insurance becomes so expensive it rivals your monthly payment? Or worse, it's just not available at any price? Then your home's value doesn't just dip, it collapses. We're talking stranded assets, entire neighborhoods becoming unsellable. A cascading failure. Remember the Canary? It's not chirping weekly. It's dead. The CNBC report said it. Some people liken the insurance industry to the canary in the coal mine for the climate crisis. The canary is just about dead. So here's the question I can't shake. If the insurance model that held up the American dream is broken, what comes next for the place you call home? Home insurance wasn't just a policy. It was a promise that underpinned the American dream. That promise is now breaking, not because of one bad year, but because the math of the planet has permanently shifted. If this map rewrites where we can live, we'll be here to chart it. So subscribe, and let's figure out this mess together. Stay curious, beans.